Okay, using this example, let's talk about an example of the margin exercise. So first we're talking about the long transaction using a margin account. Assume the investor goes long with 5,000 shares of ABC on margin. And when this sells for $2.25 per share, it's not eligible for reduced margin. So how much would the investor have to put up as margin? So first of all, we need to think, okay, it's 5,000 shares. If you're buying 5,000 shares and the price of the shares is $2.25. So obviously we're going to say 5,000 shares times 2.25. When you do that, you multiply it together and you will get 11,250. That is the value of this investment. Now, out of this investment, we said that we can get a 50% loan. 50% of this amount is 5,625. So that is what the dealer or the investment company is going to give you this loan, and that is half of it. And obviously, you as an investor have to put in half the money. So it's split 50-50. Now, let's assume the price of the shares go down, right? So you bought it at $2.25, but it went down. And of course, you're not going to be happy. You're going to be sad. In this situation, it went down and you are now in trouble. So now you can, you may get a margin call. So this actually happens every day. The investment company is going to, of course, calculate this. So you just need to know this calculation. What happens if the client asks you, why do I get a margin call? The computer does it automatically, but you need to understand this. So, and this is on a daily basis. The original cost of the ABC shares was 11,250. Now the price is $1.85, right? It went down. So we do $1.85 times 5,000 shares. That's how much you had bought. Now, if you multiply that together, and you will now, so 1.85 times 5,000, this will be $9,250, right? Now you can get 40% only loan, and that 40% of that is 3,700. Why do we get 40% instead of 50% here? Because from our margin table, if you remember, it was $2.25 and we were getting 50%, but now it's $1.85, so it falls in this range. And now the company is going to reduce the amount of money they can give you. They're going to say we can only give you 40%. So based on that, now because the price went down, the company is going to say we can give you less loan and you have to make up the difference. So that's where we got this 40% from. And when you multiply the price by the number of shares by 40%, you get $3,700. So if you minus that from the 11,250, right, that gives you the difference. So what is the margin call? The margin call means that you have to put in more money. How much more money do you have to put in? Well, you already put in 5,625 yesterday. So yesterday, what did you put in? You put in $5,625. But now you can get less loan, right? You put in this amount, 5,625, and the loan you got yesterday was 5,625 also. So now the loan amount is less now. How much is it less by? We can see here that 5,625 was the old loan. Think of it as a loan yesterday. Now the new loan is going to be 3,700 that we calculated here. So the difference between the previous loan and the new loan, the difference is 1,925. So there will be a margin call for this. The client has to fulfill, has to put down this money, and that is the net margin deficiency. That is the amount they have to put in. So if you get a question like this, first of all, think it's a long strategy. Price went down, so there will be a margin call. How much was the loan before? The loan was 5,625 before. How much is the new loan? The new loan is going to be based on the price, the number of shares. Now it's going to be 40%. This is the new loan amount. So the difference is going to be a negative number, and that is going to be a margin call. If the price went up, you're going to be happy. Instead of going down, let's suppose it was 225 and now it went up to $2.75. Now you're back to 50% because it's now over $2. So now what can the client do? The new loan amount now will be $2.75 times 5,000. 50% of that is 6,875. Now, if you see, obviously it's going to be extra money. So the difference between the new loan and the old loan is $1,250. So $1,250 is extra money in the account. Obviously, this is just after 24 hours. The next day, the client may either take the money out or they may leave it there because you never know tomorrow, the next day, the price of the shares may go down. So or they can use this money and buy some other investments. So this is the excess margin in this case, in this account. So hopefully that is clear now. And based on this example, let's take a look at the example from the CSC book, from the Canadian Securities book. This is what is they gave it there. $25 the share price, there's 1,000 shares. You multiply it together, you get $25,000 is how much you need for the investment. The company will give you a 50% loan because obviously this is higher than $2. And so 12,500, 12,500, that's half of this amount. So that's day one. Next day goes down. It goes down to $22. You're sad because it went down. You're going to lose money. How much do you lose, or how much do you have to put down more? So now we calculate $22 into 1,000. Now you need $22,000, and the loan amount is now going to be 11,000, and 11,000 is your margin. So instead of 25, now it's 22. Half of that is of course 11,000. Now what is the difference between the old loan and the new loan? The difference here is $1,500, and the client is going to get a margin call because the price went down, and because of that reason there will be a margin call to make up that deficiency. If the share price had gone up instead of going down, from 25 it went up to 29. 25 times 100 is 25,000. Previous loan amount was 12,500 each for the loan amount and the margin. Now it went up, you're happy, it's great, you're making money. It went up to $29,000 now value. Half of it, half of 29,000 is 14,500, right? Now the previous loan was 12,500, now it's 14,500, and you have got excess money available. So what is the difference between these loan amounts? Previous loan was this amount, new loan is this amount. The difference is $2,000, and that is an excess amount. That is extra money in the account, in the margin account, which you can either take that money out or keep it in and reinvest it. So this is the example which is in the Canadian Securities course.